Good morning, everybody, and welcome to the Elite Traders Club weekly analysis session for Monday, the 28th of September 2015. My football team had a win on the weekend into the grand final, so keep our fingers crossed for the Hawks as they play West Coast on this coming Saturday. It's going to be a hot day in Melbourne. I think it's going to be forecast is for around about 28 on Saturday, so certainly going to be warm playing football on that day. The disclaimer, the content of this presentation or any other Elite Traders Club material does not constitute a recommendation, nor does it take into account your investment objectives, your financial situation, nor particular needs. So before making an investing decision based on the general advice presented in any of the following presentations, please consider whether the advice is appropriate in light of your financial circumstances. Right, the agenda as per usual, portfolio management setup, portfolio management and some specific setups, a little bit of Q&A. I've also got a small alteration that I'm just going to discuss in terms of the entry requirements for our trade. So those of you who've been part of the Elite Traders Club for a long time will know that we have, up to this point in time, used 2 pips above the last medium-term peak. 2 pips, whether it's the Australian market, the US market, whether the price of the stock is $1.50 or whether it's $1,050, we've always used 2 pips, which I don't think is it's consistent in terms of a number, but I think in terms of relativity, 2 pips on a $1.50 stock compared to 2 pips or 2 cents on a $1,050 stock are certainly two different things altogether. So I'll discuss that as we go through as well. At the moment, no doubt, for everyone very much aware of the market conditions at the moment, I'd be interested to see whether or not, in terms of your feedback with any of your friends who you socialise with what they're thinking about the market at this point in time. Interesting to, I think, get a bit of a comparison in terms of how we use metrics to measure market risk and how mum and dad retail investor out there typically use gut feel to try and judge market risk, whether or not they're seeing dips in the market at the moment as buying opportunities or whether they're aware of any such concepts as market risk. Certainly at the moment in the Australian market, we're at extreme market risk. We've been there for a while. Our market's really not showing any clear direction at the moment, very much a victim of what's going on, if not out of the US, then certainly out of China, and really finding it difficult to get any clear directional movement. Having said that, the US is not much better at this point in time. It's looking very bearish over there. And as such, we are still in very high market risk, which is what we were in the last week. So in the Australian, because we're in extreme risk, we need to use a 10% market risk multiplier. So that's 10% of your maximum allowable value at risk across your portfolio, which for most of us is around about 15%. So applying that 10% to 15% means you should have no more exposure across your portfolio than around 1.5%. In the US, if you were dealing just solely with the US, and again with an allowable 15% maximum drawdown or maximum value at risk in a low-risk market, because we are in a very high market risk, we need to use a 20% market risk multiplier. So it's 20% of that 15, and that comes down to around about 3%, the same as it was last week. So let's go through and just explain that a little bit further. In this particular example, if you were splitting your capital 50-50 between Australia and the US, and you were allowing yourself a maximum drawdown of 15%, that is under a low-risk market conditions, you would be splitting that allocation of risk, if you like, between the two markets. So that would mean 7.5% maximum drawdown on your Australian exposure and 7.5% maximum drawdown on your US exposure. Because at the moment we are in extreme market risk in Australia, we are using a 10% market risk multiplier. Applying that to our 7.5% means that we are only allowed to have 0.75% value at risk exposed in the market. So if you were in the market for the very first time, you certainly wouldn't be having any more risk than 0.75% of your total allowable value at risk. Conversely, in the US there, if you were starting off brand new, fresh at this point in time, then of your 7.5% allowable maximum drawdown, which you can have under a low market risk condition, there's our 7.5%. Because we are in a very high market risk, we use a 20% market risk multiplier. 20% of that 7.5% brings us down to 1.5%. Those of you who've been in the market for a period of time are likely to have trades, hopefully, that are still holding up and doing some heavy lifting for you for the time being. Some of you, no doubt, as I've experienced in my own portfolio, will have had trades that have now been stopped out. So from that point of view, we don't want to be adding any further exposure to the portfolio. We just want to naturally allow the market to take us out of those trades. It's doing the job of reducing our value at risk along the way. But certainly, as market conditions change, we don't want to be too reactive and start strangling trades and actually cutting our nose off to spite our face and getting out of trades by, aggressively trailing stops. That doesn't do us any good whatsoever. And there's many examples of stocks in the watch list at this point in time that are actually holding up very well. Or on the other hand, some that are still continuing to move very strongly in the upwards direction as well. So, this is all about being consistent. It's all about trading efficiently and not second guessing and using those 3 words, I just thought, as an excuse to not follow your trading plan to the letter of the law. So hopefully that makes sense. Certainly there's a lot of psychology in trading. It's not to be underestimated. Everybody has emotions, etc. It's something that you need to deal with, and certainly being consistent is going to help you with your returns over the longer term, and that's what we need to be thinking about. All right, so let's have a look at where we are at the moment. If you did happen to be choosing to scale out, obviously in the Australian market, you're looking for targets of 1-to-1. I don't think that's appropriate. I think the best thing to do is to let your profits run, and if you're in good trades, then absolutely let them go. Let them keep going, because as a couple of examples, in the Australian market, I know some of you have been on Blackmores lately, some of you have been on Capilano. They're 2 trades that continue to defy the market bias, can continue to go up, and they're the ones that are doing the heavy lifting. So if you were getting out of those at 1-to-1 type of targets, then all of a sudden all that hard work that's been done by those stocks you've missed out on, and that, in my opinion, is a mistake. All right, so we'll go through and have a look at some charts and things in a moment. The macroeconomic session Jeff and I ran on Friday talked a little bit about what was happening in China, so if you haven't caught up with that, please do. The education session that I'm going to run this week will actually be a bit of a recap on the new rule that I'm just going to run past you today, but certainly we'll give a much more detailed explanation of that in this week's education session, and the watch list will be out later on this morning. So let's go through and have a look at the markets now, and obviously first place to start with is the XJR, our own market, and you can see I've just put on here excuse me, a longer term filter, if you like. It's a 200 period moving average, which is pretty much a pretty reliable sort of bull market, bear market indicator applied onto a daily chart, which is effectively the same as around about a 40-week or a 10-month moving average on a monthly chart. And we've consistently been moving downwards really since about April, just continually moving down sideways further and further. We're still in this constricting, narrowing type of formation at this point in time, and the world's really just sort of waiting to see what's going to happen. There is a lot of conferences this week held by the Fed in the US. A lot of the FOMC members are speaking on different days throughout the course of the week. So certainly the focus there will be on any language that comes out of those particular meetings. We're still down in extreme territory at this point in time. A little bit of interest as well. If we just scroll out a little bit and see how we've responded previous times when we've got down into this bull market, bear market type of zone, that we've been able to find a little bit of traction and move upwards. So every time we've dipped down before, I know that's a little bit small, I'll try and make that a little bit bigger for you. Every time we've dipped down previously, and this was towards the end of last year, the markets were very, very bearish. We managed to find some support and move back up. It didn't take too long for that to occur. And in any of the previous times when we've done that, we found support and moved back up. Again, back in 2013, found support and moved back up. And it hasn't really been since back in, this is the Eurozone crisis, where prices started to fall below and really started to make a series of lower peaks below our bull market, bear market filter. This was all the Eurozone crisis, and the market took a long while to regain any clear directional bias, and really spent a good part of 12 to 18 months going sideways. So it's something that we need to think about. Obviously, our market risk indicators at this point in time are really telling us that we're in extreme, if we didn't already know. But all the way through, we've had lots of clues that the market is undergoing some transition through the changes in our market risk multipliers, as an example. Let's have a bit of a look at and see what the story is in the US at the moment. Again, I've just drawn in here, this little dotted line is from the beginning of the year. The US market at the moment is down around about, I think that's about 5.6% at this point in time. Certainly in terms of breaking out of a narrowing type of zone, it did do that last week. It sort of broke out towards the downside. Those last two candles in particular, if we add those two together, we really just get a doji which is basically this candle and that candle being added together. You can almost join them on top of each other. Very small body, large wicks either side. Really, it's just indecision that's occurring in this market at the moment. So that's the S&P 1500. It's probably worthwhile having a bit of a historical look as well, to see how it's behaved once we've moved below that longer term filter. Let's go back and have a look at the last time that it did that. Last time it did that, it came down, closed below. We had a couple of pin bars there before moving up very, very strongly. We hit that V-shaped type of movement. It's been a long, long time since the market had spent any significant time below that level. Again, during 2012, came down below that level and moved back quite strongly. Even in early 2000, mid-2012, same sort of thing. Came back down, was able to find some traction before moving up. Prior to that, this was the same experience, the Eurozone crisis, etc. Once price moved below, closed below, and again, the US market still spent a long period of time going sideways. And then even in periods of 2010, the market, having come down, was still able to find some levels of support and then started to move back upwards. So some broad areas of support before moving back upwards. If we have a look at where we are now, by comparison, where have we got some broad areas of support? Well, we don't really have anything at the moment. We're really looking more down towards down to this type of level down here to see whether or not that's going to hold. And it's looking like the market's going to test this at some stage. It's a matter of whether the market then regains its composure and can start to move back upwards, or whether that gives way and then opens up further downward movement. I did run an educational webinar last week on taking a longer term view and talked about market cycles. So if you haven't caught up on that one, that's in the education portal. It's well worth having a bit of a look. Certainly going back to 1987 and looking at market cycles in particular, and what tends to happen every sort of 6.5 to 7 years. I think it's interesting food for thought and gives you a little bit of a context as to what potentially could happen. But certainly we're well prepared for that in any case, because we've got very limited exposure to the markets as we speak. All right, let's go through and have a look at what sort of setups we managed to find this week. I only managed to find two setups in the US that met our criteria of the right sort of price action, good relative strength, and giving us a risk of around about 10% plus or minus a couple of percent in terms of distance between entry and protective stop. There were a number of other setups, but the distance, if you like, in terms of percentage of price, we're really getting out to sort of 15, 16, 20%, those sorts of things. So really asking the stocks to do a lot of work in the current environment. So I've not put those in the watch list for that very reason. So let's go through and have a look at those now at the moment. This one probably won't surprise you too much. This is actually an ETF. It's the BetaShares US dollar. So this is really just a, if you like, it's the dollar index traded as an ETF. So this is really just showing you the relative strength of the US dollar versus a basket of currencies. Obviously, the Aussie dollar is one of those currencies, the pound, the euro, the yen, etc., etc. And for a period of time, this is on a weekly chart, very strong through the mid to latter parts of 2014. Not surprisingly, that also coinciding with dips in the broader markets as well. So if you have a look at the performance of the US dollar index compared to global stock markets, it tends to sort of work inversely as a flight to safety, if you like, in US dollars. More recently, from the beginning of the year, really going sort of sideways, and now, more recently in the last couple of months, really starting to move up. We've now put in a higher trough in terms of relative strength. Certainly, very good relative strength for an extended period of time. That last trough, is it at or above the second from last medium-term peak? Yes, it is. So let's just sort of zoom out and get a bit of an idea of where we are. So not a lot of history, all the way back to about 2011 this ETF has gone for. At this point in time, it's certainly exhibiting a lot of strength. Now, one of the things, this is the change that I'll be discussing in the education session this particular week. As opposed to using our traditional 2 pips above the high of a medium-term peak, I'm going to introduce a percentage rule, and to keep it nice and simple, we've already got a percentage rule in use with our protective stops. Remember, when we're putting in a protective stop, our percentage rule is that it needs to go at least 0.5% below the last medium-term trough, and obviously outside of your 2 ATRs. From the entry perspective, all we're going to do, rather than using 2 pips, is we're just going to change it to 0.5%. Okay, so just keeping it nice and simple, 0.5% above the last medium-term peak. And that way, when we're dealing with stocks that are $950, $250, $80, we're not just using 2 pips, which was effectively before 2 cents. We're acknowledging the fact that these zones of resistance in this particular case, they're not paper thin, they're not 2 pips thin. Let's be a little bit more logical about it, a little bit more consistent in the use of how we're going to think about entering our trades. And the easiest way to do that is just to allocate a percentage basis across the board, and that will fit all trades, whether you're trading with stocks of 75 cents or $1,000.75. So from that point of view, the medium-term peak there, you'll see there the high is 1480. Well, traditionally we would have gone 2 pips above that at 1420. Now, as a result, we're using 0.5%. So the new on-stop order for this particular trade is on-stop at $14.25 with a limit to 1432. Okay, now that 1432, that is 1% above the high of that medium-term peak. So that high is 1418. 1% above that is 1432. So we now have an on-stop order 0.5% above the medium-term peak, with a limit another 0.5% above that on-stop level. So we're still giving the trade a window in which to trigger, and a protective stop. We need to take that from our entry level. So 1425, we need to deduct from that at least 2 ATRs, and we also need to make sure that we are at least 0.5% below the last medium-term trough. And so therefore we have our protective stop coming in at $13.51. That's USD, Beta Shares, US dollar ETF. All right, the next one from the US, and this was only two out of a list once I ran the scans the other day on Saturday morning. It came up with a complete list of, I think it might have been around about 100 outputs, and most of them were the troughs that anything that did tick the price action filter box. They were going to present trades that had risks of 16, 18, 20%, etc., etc. So really being pretty picky at the moment in terms of making sure that we've got trades that are certainly around that 10 to 12%. But on the same token, I think we've been pretty consistent in using that across the board as well. Certainly, if you do take on trades, if you yourself choose to take on trades that are further than that sort of 10 to 12%, you just need to realise that you're asking the trades to do a little bit more work. Certainly, the price action filter is there to help you sort those better price action ones from not. So here we are, Signet Jewelers. So let's just zoom out and see where we are. We're at all-time highs. So again, the question is, well, how is this thing at all-time highs when the market is been going sideways, rolling over, etc., etc. So really good relative strength of late over the last 5 or 6 weeks in particular. You'll see at this point that the stock itself has pretty much been going sideways between this sort of, what's that, $115 and around about $130 odd dollars. So what I might do, I actually wanted to just delete that for a tick, and I actually wanted to put on the rectangle because the rectangle just highlights things a little bit better. That we've really sort of been moving in a sideways movement here in pretty much a box sort of formation. So just sort of basing for a period of time, and the clue that price is about to move out of the box, obviously we're looking for the formation of higher troughs. So in this particular example here, you've got price moving sideways, and we've got the formation of that higher trough looking like it's ready to break out the side of the box. So if I take that out of the way there now, all I'm really thinking about was where is that trough in relation to the second from last peak? Well, the second from last peak all the way down the bottom here at around about $120. So very strong price action from that point of view. We're past this last, what is effectively a major point of supply through here. We've already tested that. We've come back down, and we're looking to move onwards and upwards. So the structure for this particular trade, we've got an on-stop order there at 143.64 with a limit to 144.35. So that on-stop order there, that 143.64, that's 0.5% above our last medium-term peak there. The last medium-term peak there at 142.93. Our protective stop needs to be outside of 2 ATRs, and it needs to be at least 0.5% below that last medium-term trough, and that protective stop coming in at $131.18. That gives us a risk on the trade of just under 9%. That's SIG. A couple of questions there. Kay says, isn't USD and ASD stock? It's an ETF. So there's a number of ETFs that follow the US dollar basket, and you can actually trade that as an ETF on the Australian market, but also on the US markets as well through either Saxo or IB as an example. Ken says a few trades have survived, but most of my funds are resting. Well, that's what they should be doing at this point in time. We don't really want to be putting money into the markets at this point. Our indicators are telling us that we're certainly in extreme or very high market risk as we speak along the way. Hello, Kim, over in US at the moment. Cool technology, on a jet to Boston and have complimentary Wi-Fi at 40,000 feet. Wow, fantastic. I wonder if you can pump me through the intercom there and everybody can sit back and listen to the dulcet tones. Cannot hear you though. Okay, well we'll be catching the webinar at the hotel. Very good. Well, thanks very much, Kim, for that little bit of information there. Beryl's got a question there. Please inform on TPM and SYD, Sydney Airports, I think, which are going well. I am in it. We can go and have a look at those in a moment, certainly. A couple of other notes as well. So we didn't have any new setups in the ASX. Did have a couple of trailing stops. Does anyone know which stocks were trailed? Just out of curiosity, one's on the screen. CZZ, Capilano Honey. So again, the reason why it has trailed the stop higher is that you'll see we've got a higher close once again. So all these higher closes are dragging that 3 ATR trailing stop up higher and higher. So that's a very good thing. Again, just remember you've got price volatility, price volume and volatility signals going off. So if you happen to be in a trade like this and it's performing well, it is an opportunity for you to take some partial profits. And then obviously look for another opportunity to add back in. Keep with the strength, let your profits run. So that stock performing very, very well. Auckland International Airport is still going in the right direction. Had been showing some weaknesses. Had a very good week last week. Nice candle on that one. ARB, again, last week a bit of a doji. Really not doing anything for the time being. BWP, last week, again, really sort of lacking clear direction there. GHC, again, this continues to move in the right direction. You'll notice last week that we did have a price volume volatility signal going off. So depending on your entry level of that, how much you've made, we're still certainly clear, well past 1-to-1 on this as an initial trade entry. So some partial profit taking there, should you deem that appropriate. GOZ really hasn't done much there at all. IVE, this is one that stopped out last week. This is a ETF that represents both the Asian and European markets, closing below its trailing 3 ATR stop. So that's a exit at market this morning on IVE. James Hardie at this particular section, look, we've put in the formation of a lower peak. Typically that would mean that you would have to ram, cram and jam up to below the last medium term trough. We don't do that anymore. We've got our trailing 3 ATR stop in here and we just abide by that. We're patient and let the trade unfold. Aurizon Holdings, again, last week, it's still a white candle. Interesting that last week it opened much lower than the previous week, was still able to eke out a higher close for the week compared to the open, so therefore we've got a white candle. Be nice to see a little bit more strength of this coming through. Given when we actually got in and what happened with the market from that point of view, it's actually held up reasonably well along the way, so that's a positive sign. AHD, last week, black candle there. A little bit of a wick on the tail of that. It would be nice to see a higher close this week, and if we get a higher close this week, then it's going to drag that 3 ATR line up a little bit further as well. APE, it's still holding up reasonably well over the last few weeks, and no reason to do anything with that at this point in time. MyNet Phone, really just, it needs to really get a wriggle on. We discussed this the previous week. And nothing to do there for this point in time. Blackmores, again, it just keeps going up higher and higher and higher. The Chinese obviously love good quality vitamins. They did buy out Swiss, or a Hong Kong-based company bought out Swiss Vitamins the previous week. In fact, on the macroeconomics analysis session on Friday, Jeff actually talked a little bit about Blackmores, Capilano Honey and Bellamy's, as well as being a producer of sort of dairy-based products at which at this point in time the Chinese are certainly very interested in, and all stocks that have performed very, very well on the back of that sort of more broader fundamental news in the background. So Going very, very well. So hopefully those of you that are in Blackmores are still in it and haven't sold out because I just thought. That's not your job. Your job is to stay in this until you either get a price volume volatility signal, which says, okay, at that point you can choose to take half off if you like, obviously with the mind to get back in again, but also making sure that you stay in until this thing closes below its 3 ATR. So that's Blackmores there. In the US, let's just go through a couple of stocks that have stopped out in the course of this last week. AYI is one that, here we go here. Pretty dirty candle last week, closing below its trailing 3 ATR, so giving a bit back in that particular example. And this is what happens sometimes when trends come to an end. And this is one of the things, if you've ever read The Way of the Turtles, if you like, the book by Curtis Faith, what a lot of the turtles actually struggled with with their trading was giving back a certain amount at the end of trends. So that some of them found that particularly difficult, but they also realised that the other side of that particular difficulty was that by following basically a trailing stop type of procedure, that they actually allowed them to participate in some very, very long trends. In fact, the Way of the Turtles, the way that Richard Dennis taught those guys how to trade was effectively they were going to lose around about 70% of the time. However, when the trends came along, they were in trends for a long, long period of time and still made, on average, around about 80% per annum on their portfolio. So, again, the market is not going to trend all the time. The last few years, particularly in the US market, it has trended very, very nicely. So just following that particular methodology over those, the last 4 or 5 years would have stead you in very good stead. So that's AYI. Another one that's EBS, I think it was. That's the one there, Emergent Biosolutions. When you're ready, be on charts. So it's difficult when you click and nothing happens. I'm sure it'll come through in a moment. So EBS was one. And the other one was VRX, I think it was, which we had a close below the 3 ATR as well. EBS. So that particular example there, it's closed below the 2 ATR. So that, for the time being, that's a soft stop, which will be now converted to a hard stop, 0.5% below the low of the candle that breached it. Over the next coming weeks, you might remember last week I talked about the concept of the initial stop being a soft stop, then going through the process of converting to a hard stop when breached. I mentioned that I wasn't entirely comfortable with that. Certainly over the course of the next Wednesday, probably, in its education session that we'll do that week, I'll discuss the notion of a different way of handling that initial stop. The reason for that I wasn't all that excited about using or converting a soft stop into a hard stop is that sometimes when these soft stops are breached, price can move down. As an example on this one, it may move down to $22, and therefore that would mean that we have to put in a hard stop just below $22, and therefore when you think about your initial risk on the trade, well, the initial risk on the trade was only around about $4, and then all of a sudden I'm having to put in a hard stop, another $7 lower. So I'm not comfortable with that concept at all, and I've got a specific idea that I'll be discussing in about a week or two on the education session. So that was EBS. VRX was the other one, so we'll keep our fingers crossed that VRX comes up quickly and Beyond Charts doesn't have too much of a fit. There we go. As an example, price closing below our trailing 3 ATR on that one. If you were fortunate enough to get in this particular trade as it moved out of the box there. So again, this is those of you who Want a good book to read? Go and read Nicholas Darvis, How I Made $2 Million in the Stock Market. This basically box type of movement, a basing pattern. The clue that it was about to move out was these higher troughs, moved out. And I think by the time it was actually picked up was through here, past the $200 level. Certainly it's been at all-time highs ever since then. That was the point of entry back in, I think, around about April, May time. Since then, it's really just sort of, it's moved up a little bit, but of recent times really started to weaken off and eventually drop below its trailing 3 ATR. That was a VRX. One trailed stop in the US was NVR. So I'll just bring that up, NVR. And with a bit of luck, that will come up quickly as well. Maybe we need a bit more luck. A couple of cancelled orders as well, which will be in the watch list. One from the 21st, ABMD, was one that will come out of the watch list on the pendings list, and the reason it will be coming out is that it formed a lower peak. So anything that's formed a lower peak, it has poor price action and therefore needs to come out of the list. Another one that is cancelled out of the list is FIS. There we go. So NVR, last week, if we just go scroll in a little bit, we've got a higher close last week than the previous week, and as such, it's just managed to trail our trailing stop up and just above, or not quite. Let me have a look there. I don't think that's, actually, it looked like it certainly has pulled up the what will be the trailing stop, but at the moment that trailing stop is still just slightly below our initial stop. So if we get a higher close this week, that should drag that up beyond our initial stop. That's about it for those trades that are in the watch list as we speak. A couple of questions through there. Beryl's asking about TPM and SYD, so let's go and have a bit of a look at those on the Aussie market. SYD, Sydney Airports. Sydney Airports was one that was in the watch list a little while ago. And as you can see, Beyond Charts is just struggling a little bit. This was in the watch list, and you'll see how the trailing 3 ATR has again helped you to keep in a trade in an upwards direction for a long period of time. More recently, there was a dividend that was declared, but at the same time, price closed well below once that dividend had been taken into account, and that was the candle back there. Since then, moving up really very, very strongly. Just put on the swing chart, so just to highlight those peaks and troughs along the way. I do have a lot of things open on my computer at the moment, and so as a result, Beyond Charts just sort of struggling a little bit. Certainly the fact that we've put in a higher trough than the previous one is certainly very good. Nice thing about this at this point in time is that we've cleared this really a fairly significant point of supply. So it's done that. Last week's candle, very, very good. If you're in that, nothing to do. Stay in it. It's looking very good. Okay, TPM. Let's have a look at TPM. Okay, and again, moving very, very nicely. Interesting about this particular stock. It has, for a period of time, been consolidating, going sideways. Remember, the market has a habit of pushing stocks up a bit too far. Market needs to regroup, rethink what's going on. Certainly in terms, was there any clue that this one was ready to move out of the sideways movement? Not really. We didn't have higher troughs, and as such wouldn't have come up on a scan through our price filter requirements. But certainly very good relative strength, moving on very, very nicely along the way. So if you're in it, stay in it. The rule is don't get out unless it closes below its trailing 3 ATR. Why is this stock performing so well? against the broader market? Who knows? There must be something in the background. Obviously, the fundamentalists, the big guys who drive the market, like it. So if they like it, then that's going to be good for your portfolio. Kay's just asked about BKL. You might have been answering the question, which stock had the stop trail, BKL. Hopefully you're still in that one, Kay. I think you might have put your hand up in previous weeks. All right, they're pretty much that's all the questions for this particular week. That's all the questions for this point. Up to this point in time. Might just, before we finish off, might just go and have a look at a couple of stocks from the 21st that we had on our list. This was one that when we were looking at it a couple of weeks ago here, it didn't go in on the list because at that point in time, having a stop loss below that most recent trough meant it was going to have a risk on it, if you like, of around about 18% in terms of price movement, just to get back up to the last medium-term peak. This was from the scans of the 21st, so last week that was. But since then, you'll notice last week, we've put in a lower high and a lower low, that last candle. So as such, we've now formed a short-term downtrend, which also means at the same time, we've formed a new medium-term peak. That peak's lower than the previous peak. That would on its own nullify any price action filter, and therefore that would come out of a list if it was in there. But from the 21st, we did have FIS, I think was the one that I mentioned before. So let's just... this one here, this one was in the actual watch list because from percentage terms, it met the criteria. Last week, putting in a lower high and a lower low, so therefore confirming the formation of a medium-term peak. That last medium-term peak is lower than the previous medium-term peak. So that now nullifies the price action filter, so that will come out of the watch list as a result. From the 14th to the 9th, the previous week prior to that, we had MD. Now MD at this point hasn't triggered. It's getting very close to it at this point in time. Last week's high there, 85.97. The on-stop order there, 86 and 11. So that one's still in there as we speak. But from that particular list, ATR was one that was in there, and that is now coming out. Again, same sort of things happen. We've got the formation of a lower peak, so therefore our price action filter has now been nullified, so that will come out of the watch list. CHE, Chemed Group or Chemed Corp, same sort of thing again. Formation of the lower peak, that's going to come out of the watch list. Can't remember whether that one got in there or not. It may not have. This might just be my analyses that I've been looking at. But in any case, it doesn't hurt to go through and look at previous setups and realise, what's happening, what's been going on in the market, what's been happening with the price action, and therefore the reason for any possible cancellations. ICLR, from memory, was in there. Maybe it wasn't 15%. Oh, yeah, I'm not too sure. But again, that last medium-term peak there, now much lower than the previous medium-term peak. Price action filter, all marked up. That comes out of any watch list as well. Beryl's just got one more question there. MQA. I'll have to go to my Securities Explorer. And certainly a stock that, again, if you go through and have a look at this, an example, set up way back in 2013 in terms of price action and everything ticking the boxes, and as opposed to getting out at round numbers of $2.50, etc., using that 3 ATR line all the way through. Price is now at 370 as an example. So that 3 ATR line has done a fantastic job of keeping this trade alive. Think about what the initial risk on this trade was, around about 24 cents. And that 24 cents has now grown from $2 into $1.77. So 24 cents has effectively now grown into $1.77. So by getting out at a round number per se, which I think is a mistake, that mistake there has cost you around about $1.50 in upwards movement. So that's about around about 7.5R in terms of what that mistake has cost. Going really, really nicely. It's just, again, a little period of sideways movement through here. It's moved out strongly now. Last few weeks have been very, very strong. Nice high troughs, going really well. No reason whatsoever to get out of that if you happen to be in it. All right, folks, that's about it for this particular week. As I said, Wednesday I will run an education session on the way that we're going to structure trades from now on, keeping it very simple. The whole concept of 0.5%. It's in alignment with 0.5% below the last medium-term troughs. It's a nice, easy calculation to do. And it's also going to mean that no matter where you are trading, what price the stock is, it's going to be consistent in terms of a metric based on price. All right, folks, I hope the market treats you well this week and we get a bit of upwards movement for any stocks you've still got in your portfolios. If you've been stopped out in any this week, remember, that's not the time to be adding. Being on the sidelines, protection of your cash is very, very important. We don't know where this market's going. I would expect a fair bit of volatility this week if the market doesn't like what the Fed says, or if there's ambiguous terminology being used, then the market is certainly not going to like that. All right, folks, so we'll catch up with you, if not on Wednesday, certainly on next Monday. In the meantime, bye for now.